Time now for our weekly Money News Roundup, where we break down the latest in the world of finance to help you be smarter with your money.
Today, we're talking about the not so great home buying season that we've all been experiencing and why it was years in the making. Our news colleague, Anna Helhoski, is back to talk about it. Hello, hi, hey, Anna.
Hey, Sean. Hey, Elizabeth. So, August is in full swing, and that means that the traditional home buying season's winding down. Now, the latest data from the National Association of Realtors shows just how sluggish the market has been. Mortgage rates rose from June to July, while existing home sales fell 1.7%. But there's a little bit more to this story. Existing home sales were up 0.9% from a year earlier, and that means that July 2026 was still better than July 2025. And that's largely because mortgage rates are lower now than they were at the same time last year. But for buyers who spent the spring and summer frustrated by a shortage of homes for sale, there's still one big reason that the market feels stuck, and it goes back to the pandemic. Millions of homeowners locked in historically low mortgage rates in 2020 and 2021, and 5 years later, many aren't willing or able to give them up. Today, we're looking at how that pandemic mortgage boom is still shaping the housing market. New NerdWallet research shows just how dramatically conditions have changed for buyers. We're joined by mortgage writers Abby Doyle and Kate Wood. Welcome back, you two.
Oh, thanks, Anna.
Thanks. Happy to be here.
So, Abby, take us back to 2020 and 2021. What was so unusual about mortgages then?
So mortgage rates got really low. In 2020, the average rate on a 30-year fixed rate mortgage fell below 3% for the first time ever, and it generally stayed there until around September 2021. So people rushed to buy, millions of existing homeowners refinanced, and they were locking in these incredibly cheap loans. And a huge number of those loans are still on the books. Almost half of outstanding mortgages today have a rate of 4% or less. And that's according to Realtor.com's analysis of federal data.
Now, Kate, NerdWallet has some new original research that really puts that moment into perspective. So tell us about the new Home Buying Climate Index.
We've just launched this new stat. Basically, every month, the NerdWallet Home Buying Climate Index gives the national market a score and a sort of weather forecast comparison based on how favorable or not favorable conditions are for buyers. So we look at 5 major data points: mortgage rates, no surprise, home prices, incomes, unemployment, and new construction. So we put all of these together to kind of give you a snapshot of the housing climate at the moment, and then we can also take a look historically.
So if we turn the clock back to the pandemic, what did the forecast look like at that point?
It was beautiful, right? It was sunny. It was gorgeous, right? Just perfect get outside weather. March 2021 had the best home buying climate index in over 30 years of data. So the number is out of 100. March 2021, it was at 89.5, right? So as Abby mentioned, that was when we were kind of coming to the end of this brief window of mortgage rates hitting historic lows. But, wider context, at that time, unemployment was falling. We might remember personal incomes were getting a boost. We were getting those pandemic stimulus checks. And also, builders were starting to get moving again and pull more permits.
Right. We were just in a very different environment that we are now. So what happened next?
Very different. Very different. So then we get 2022, which saw a real reckoning for the housing market. So all of that competition that Abby was talking about, people buying like crazy in 2020, 2021, that had sent home prices skyrocketing. At the same time, we've got the Federal Reserve realizing, this post-pandemic inflation isn't going to be, their preferred word is transitory, but basically it's going to be sticking around. So we've got the Fed raising the funds rate, and we've got mortgage rates shooting up too. Housing affordability is deteriorating pretty quickly. In a normal environment, you'd expect that higher mortgage rates would lead to some kind of softening of prices, right? The sellers would have to budge. But that did not happen, and our index plunged, right? You see this steep drop off in 2022. The clouds come rolling in. And we've seen, conditions bounce around since then, but we have not come close to that 2021 peak or really even to where we were before the pandemic.
And that sunny 2021 market is casting a pretty long shadow on today's market. And the people that scored those great mortgage rates then are now part of the reason that today's buyers feel so stuck.
How does that happen?
Basically, they've got a deal that's too good to give up. So say you have one of those 3% mortgages. You want another bedroom or you'd like to move closer to family. And selling your house means giving up that 3% mortgage rate and taking on a new mortgage closer to 6 or 7% these days on a home that probably costs more too. That's the mortgage rate lock-in effect. You can afford to stay, but you might not necessarily be able to afford to move. And that's why people call it the golden handcuffs.
So, Kate, can you actually see that lock-in effect in the mortgage data?
You really can. And as a huge mortgage nerd, this is something that I find actually really fascinating. So historically, if you're looking at existing mortgages, your biggest group of outstanding mortgages, so loans that people are still actively paying off, right, is always about 1 to 4 years old. And that makes sense, right? You're always going to have new buyers. You're always going to have people refinancing. There's always going to be new loans. But recently, we've seen this shift where that is no longer the case. So again, looking to this Realtor.com analysis of data from the Federal Housing Finance Administration, right now, a record high 41% of outstanding mortgages are 5 to 7 years old. And that is these people who are hanging on to these 2020, 2021 vintage loans, right? And so that compares to loans that are 1 to 4 years old at 29%. Normally, again, that's the largest group. So we are really seeing this huge wave of these pandemic era mortgages just sticking around, which means, okay, sure, those people aren't refinancing. We would expect that, but they also are not selling, right? These loans are just not going anywhere. And really, if we stay in this state, in a few years, potentially we're looking at mortgages that are 10 to 12 years old, probably being a larger proportion of existing loans than we would have ever seen before.
So we already have this giant group of homeowners holding mortgages from a completely different interest rate universe, and it's probably going to get bigger?
It's not necessarily going to get bigger. It's that
Okay.
the largest group of existing loans is likely to keep getting older, right? Rather than the kind of newest cohort of loans always being the bulk. And the reason that we're seeing this is because the rate that someone has versus today's prevailing rates really have a profound effect on whether people are going to sell. Researchers at the Federal Housing Finance Administration a couple years ago found that for every percentage point that your mortgage rate is below today's going rate, your likelihood of selling is going to drop about 18%. So think about Abby's example a minute ago of someone who's got roughly a 3% mortgage rate. Even if we kind of ignore, after that decimal place, we're still looking at someone who's roughly, 3 solid percentage points off of today's rates. So looking at that FHFA research, that person is so much less likely to sell, right? So if every percentage point drops your likelihood of selling 18%, we're doing that additively. Someone who is 3 percentage points off prevailing rates is more than 60%, if we put it all together, more than 60% less likely to put their home on the market.
And if you're a first-time buyer, looking right now, or if you bought in the past couple years like I did, it's really easy to be like, oh, boo-hoo, champagne problems, your mortgage rate is too low. But having that low mortgage rate really is a burden for today's existing homeowners. Maybe your family's grown and you need more space, or maybe you're retired and you're like super ready to downsize. But then you look at the payment on your next house and you're like, I literally can't make this work. And a lot of people who do sell right now and are giving up those great rates are selling because life forces the issue, something like a death or a divorce or relocating because of a job. Otherwise, staying put may make the most financial sense.
I can't help but think about the overall availability of homes. When enough homeowners are staying put, there are going to be fewer homes for everybody else.
Exactly. And in this case, we are literally talking millions of fewer homes. So same FHFA researchers looking at this mortgage rate lock-in effect, they estimate that from like mid-2022 to mid-2024, rate lock-in prevented about 1.7 million home sales. So these are homes that theoretically probably should have changed hands. And then here's the even bigger twist. Higher rates just on their own, which is exactly what we were seeing in that 2022-2023 time period, those should have pushed home prices down about 6%, right, on their own. They should have been depressing prices. But rate lock-in was squeezing supply so much that in itself was pushing prices up about 7%. So that's where that price relief went. It was completely wiped out by this lack of inventory.
So higher rates made mortgages more expensive and helped keep home prices high.
Yeah, it is quite the 1-2 combo if you're a home buyer.
So if lock-in's keeping this many homes off the market, Abby, what could actually help loosen things up?
Long term, we need to build more affordable homes. And that's why you've heard us talk about the 21st Century Road to Housing Act the last couple times we've been here.
No. Housing supply is basically our favorite recurring character at this point.
Pretty much. And this landmark new housing law is designed to make it easier and cheaper to build new home. But like we've said before, those changes are going to take years to play out.
I'm actually starting to think about buying something. So now this is kind of scaring me off. What if you do want to buy now?
So if you do want to buy now and you're looking for practical advice, I'd say be disciplined, but stay flexible. First, know your must-haves and know your deal breakers. So that way, limited inventory doesn't make you feel pressured into a compromise that isn't the right fit for you. And then figure out where you can flex. Maybe you're flexible on exactly which neighborhood you want to buy in, or maybe you start looking at new construction, or maybe you're looking at a townhouse or a condo instead of a detached single-family home. And finally, of course, be ready. Have your finances lined up, have your pre-approval ready, so that way when a good listing appears, you're all locked in and you're ready to move quickly.
All right, that's some helpful advice. Now, Kate, let's bring it back to NerdWallet's Home Buying Climate Index. What does the data tell us about where buyers stand today?
So nationally, the forecast is partly cloudy. Yes, it's a long way from the sunshine of 2021, but it is also a very long way off from our absolute bottom of the index, which is back in 1991 when, you're glad you weren't buying a home back then, right? Something that's really important to remember, though, is that this is a national level statistic. So we are looking at this, weather, so to speak, for the entire country, not the forecast for your local zip code. Depending on where you live, you might have more inventory, less competition, you might have more room to negotiate. That's something I was definitely hearing the other week talking to loan officers at the mortgage brokerage that we own, actually, Next Door Lending. For me personally, I'm in Connecticut. My market's terrible. I would say it's worse than the national level. In any event, this is why I would really recommend checking out the Home Buying Climate Index on nerdwallet.com. When you look at the visuals, you look at the different graphs, this whole shift that we're talking about is pretty much impossible to miss. You can really see that we have this extraordinary outlier in that pandemic era market. We've got this plunge in 2022. And yes, we're not, where we were even pre-pandemic now, but also things have been a lot worse. Also worth noting, we are updating the index every month as rates change, prices change, the economy itself changes. You can keep checking the forecast to see whether conditions are getting sunnier or if there are some more clouds on the horizon.
All right, we'll put a link to NerdWallet's Home Buying Climate Index in the show notes. I know that I will be keeping track of it myself. Abby and Kate, thanks so much for joining us.
Thanks, Anna.
Oh, always a pleasure.
And thank you, Anna.